Today, we will talk about an important aspect of financial management, appropriation. Appropriation is when money is set aside for a specific purpose. A company or a government appropriates funds in order to delegate cash for the necessities of its operations. Appropriations for the U.S. federal government are decided by Congress through various committees. A company might appropriate money for short-term or long-term needs that include employee salaries, research and development, and dividends. Appropriations tell us how money or capital is being allocated, whether it's through the federal government's budget or a company's use of cash and capital. Appropriations by governments are made for federal funds each year for various programs. Appropriations for companies may also be known as capital allocation. Appropriation could also refer to setting apart land or buildings for public use, such as for public buildings or parks. Appropriation can also refer to when the government claims private property through eminent domain. In the United States, appropriations bills for the federal government spending are passed by U.S. Congress. The government's fiscal year runs from October 1st through September 30th of each calendar year. Each fiscal year, the U.S. President submits a budget proposal to Congress. Budget committees in the U.S. House and Senate then determine how the discretionary portion of the budget will be spent through a budget resolution process. The process yields an allocation of an amount of money that is assigned to the various appropriations committees. The House and Senate appropriations committees divide the money up between the various subcommittees that represent the departments that'll receive the money. Corporate appropriations refer to how a company allocates its funds and can include share buybacks, dividends, paying down debt, and purchases of fixed assets. Fixed assets are property, plant, and equipment. In short, how a company allocates capital spending is important to investors and the long-term growth prospects of the company. Investors monitor corporate appropriations of cash by analyzing a company's cash flow statement. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow of a company is divided into three activities or behavior. Below is the cash flow statement for ExxonMobil Corporation from September 30, 2018, as reported in its 10-Q filing. The cash flow statement shows how the executive management of Exxon appropriated the company's cash and profits. Whether Exxon's use of cash is effective or not is up to investors and analysts to debate, since evaluating the process of appropriating cash is highly subjective. Some investors might want more money allocated to dividends, while other investors might want Exxon to allocate money towards investing in the future of the company by purchasing and upgrading equipment. Appropriated retained earnings are retained earnings that are specified by the board of directors for a particular use. Retained earnings are the amount of profit left over after a company has paid out dividends. Retained earnings accumulate over time, similar to a savings account whereby the funds are used at a later date. The limitations of an appropriation. For investors, the cash flow statement reflects a company's financial health. However, there are limitations to analyzing how money is spent and how a company's growth strategy impacts cash flow. Here are three key takeaways. 1. Appropriation is the act of setting aside money for a specific purpose. 2. A company or a government appropriates money in its budget-making processes. 3. In the U.S., appropriations for the federal government are earmarked by Congress. Hope this would help. Thanks for watching.